All right, so we couldn't hold 50. What does it mean?
Well, manufacturing globally is contracting. The U.S. is not immune to that in any way. Fortunately enough, if you take a look at the last core retail sales reading out of the United States, over 5% growth. If you took a look at Germany, over 4% growth. China slowing, 7. So at least right now, we have this gap between a growing demand side economy around the world, low inflation, and importantly, easing central banks to outlast this manufacturing contraction. But this is what they should worry about, and this is what we should protect.
You're worried about duration here now. How long this lasts?
We have to outdistance this contraction in manufacturing, which is in part a function of the trade war.
All right, so it all comes back to, makes October 10th and 11th more important, right, as these talks kick off?
Yeah, no, trade is clearly a factor and an issue here. But let's be clear about this. The rollover in global ISMs began far in advance of the trade war. And this has been progressing over time. It was a second derivative change that we identified in mid-2018. Now, trade exacerbated that rollover. And our argument for some time has been precisely that U.S. ISMs would follow global ISMs into contraction, whereas many of my peers disagreed with my team and I. It has happened. And in fact, we're actually starting to see the consumer weaken a little. That's been the sole pillar of strength that the bulls have been resting their hat on. You know, personal spending was weak on the last print, and retail sales have frankly been quite volatile, and we're starting to see lending standards start to tighten to the consumer. And last point here, yes, the Fed is in a mid-cycle ease, but history shows very clearly that does not prevent economic slowdowns. And moreover, there isn't much room for the Fed to act this part of the cycle.
So what's your focus? What's your expectation then for the consumer, if you're citing at least what you believe is the beginning of some signs of weakness?
Yes. I mean, look, our job as strategists is to try to identify that inflection point, as difficult as that may be, because by the time the data goes deeply into contraction, it's too late, right? Markets have already reacted. So the focus on the consumer is, does this consumer still have access to credit? Because let's be clear, real wages have not grown the way they have in previous recoveries. They've been growing at about 0.8%, which is it's well below what you should be seeing.
And the question is what central banks around the world, and especially here in the U.S., will do to react to that, and what kind of firepower they have with regard to a potentially weakening consumer, weakening manufacturing sector.
Well, let's bear in mind that the U.S. consumer is going into this manufacturing slowdown with a personal savings rate at 8%. It's going in with a record low consumer debt burden, and we're looking at things like housing and consumer durables, not having like this massive top in it. So we don't have just tremendous exuberance in the broader economy. We have healthy fundamentals, very much in contrast to some corporate fundamentals in a few particular areas. And so if we have low inflation, we have easing monetary policy, yes, there will be some manufacturing slowdown impacting those same workers. But we overall can hold this together, whether this is a recession regime or a slow growth regime is really the question. And there's a big difference between them.
You just said savings rate 8+. We know about 12 months expectations. Are the gaps widening between current condition and the future? What makes you think spending is going to hold in?
Well, I think that we have the inertia behind us of the sharp improvements in labor markets and the things that typically happen, right, when you have a central bank that's ignoring the signs of a downturn, when you get an oil shock, 1991. You see what happened in Saudi Arabia. This is not being transmitted to consumers. And I think that when we take a look at an easing central bank now and the Federal Reserve's lending standards survey, you can see that there is no crash here going on in the availability of lending to consumers. So I think we will hold in. There will be a slower outlook. But when you think about markets reacting already, we now have the world's lowest historic interest rates. Again, we've gone there a good deal now in terms of taking down expectations. Not perfect, but we've gone a long way.
Others would say S&P has become a defensive asset, right? So if we can bang out 1% to 2% in this global environment, all the money's going to come up to us.
Yeah, listen, Carl, I mean, this is typically the way things play out. There is a rotation of capital flows into the U.S., typically late cycle. That's not unusual, especially with interest rates as low as they are. Dividend yield on the S&P exceeds pretty much everything else. But here's the thing. Equities are not a risk-free asset, okay? And that, I think, is the misperception amongst a lot of global investors. Equities have risk. They react to the economic cycle. And unless we don't think we have economic cycles anymore, then I think equities are probably mispriced to the cycle risks that are right in front of us.